Hey everyone, Couch Investor back to another video for today and back with another X amount of stocks to watch or buy in a certain month. We're already in the month of April. How crazy is that? So yes, month of April, at the end of the month, earnings season yet again. Now, as we do with every video like this, I'm gonna pick 4 companies that I think are interesting or should maybe interest some of you. Some of these companies I own, sometimes I don't own even one of those. And yes, maybe sometime some companies come back again and again in each edition. Now, I'm not going to talk about Microsoft or Tesla in this video. Of course, these are all great buys. Just picking 4. And yes, you can comment your picks down in the comments below. Now, if you enjoyed this type of videos, leave it a thumbs up, subscribe if you have not. I would really appreciate that. Let's try and reach 30,000 subscribers by the end of the year. Now, if you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Now, first company is a semiconductor company. No, it's not Intel. No, it's not AMD. And no, it's not Nvidia either. It is ASML, European company actually. So this is a basic overview of the current state of ASML. Of course, you can buy it on the Nasdaq. If you're in Europe, you can also buy it in euros. Now, revenues are all in euros here. So in the last 12 months, $21.17 billion. Free cash flow positive, quite a lot, $7.2 billion in the last 12 months. Return on equity, exceptional here, close to 60%. Gross profit margin of 50%. And then price earnings to growth ratio in the next 12 months, 1.62%. So not that expensive, not cheap either. Okay, of course, if you look at the forward PE, that is maybe a bit expensive-ish, 33.3 times. Now, in the last 3 months, so basically close to year to date, stock is up 25%. In the last year, the stock is just up 3%. Now, 2022 wasn't such a great year for ASML, for a lot of semiconductor companies out there. There were some struggles overall. There's also now these restrictions with regards to selling to China. How will that impact a company like ASML? We're going to have a talk about that right now. So apparently the Dutch government told Parliament on Wednesday, and this was at the beginning of March, that it plans to draft additional rules restricting exports of semiconductor technology to protect national security. The planned rules are one of the first official signs the Dutch are moving forward in response to pressure from the United States to place curbs on technology it sends to China. Netherlands Trade Minister Liesje Schrijnemacher, I hope I didn't butcher that last name, is expected to explain in interviews the new rules will ultimately make it possible to restrict the export of some advanced lithography tools made by ASML. So of course this might and will probably impact the business overall, but analysts are expecting 2023 to be a much better year than last year. For example, analysts expect now a robust 2023. The consensus estimate for the first quarter earnings is €20.06 per share, an increase of more than 30% from a forgettable 2022. Now, last year, the company wrestled with Chinese trade restrictions and a weaker semiconductor market. Not that it was all so bad. Gross margin at the end of the year was 50.5%, while the company ended the year with a record 40.4 billion euros backlog. And you've probably heard this before, ASML, basically monopolistic company. Yes, pretty close to that. So ASML has gained share in lithography to over 80% compared to less than 55% 10 years ago. And by the way, one of the companies that helped ASML stay afloat in the early days was Intel. Imagine if they kept their shares or maybe invested more or took that company under their own wing. What could have happened? And last thing here when it comes to ASML, so apparently ASML's CEO visited China, and this will unlikely to give immediate relief to China's embattled chip sector as geopolitical tensions swirls. Of course, they are still trying to somehow sell some, machinery, some technology to China that are maybe not under the strict restrictions. We've seen Intel, I believe Nvidia try to do the same thing. Remains to be seen what happens there, but overall, I don't really think this should impact the business that much. There are a whole wide world that would love to get ASML technology. So that was ASML. Now, stock number 2 is a pretty popular stock here on this channel. We're following this company along for a while, and that's SoFi. Of course, I talked about SoFi not so long ago when, well, banks were blowing up, run at the banks, etc. I explained why SoFi is much different than a bank like Silicon Valley, for example. If you missed that video, it's going to be in the top right corner. And so I want to mention and put SoFi out there because still at just over $6 right now. Yes, year to date, it's up 31%, but still I feel that currently the market is punishing SoFi a lot. Yes, of course, free cash flow, still very, very negative here. Revenue has been increasing year over year, no problems there. Return on equity, still negative here. Then gross profit margin, we're close to 80%. Price to sales ratio in the next 12 months is just under 3x. Of course, the overall business not profitable yet, but they do expect to be GAAP net income profitable in Q4 of this year. So a quick reminder for you for Q1, which just ended. So they expect adjusted net revenue to come between $430 and $440 million. That would represent approximately 35.5% growth year over year. Adjusted EBITDA of between $40 to $45 million, and then adjusted EBITDA margin to be at 9.5%. Now, when it comes for the full year, they expect to grow adjusted net revenue approximately 27.5% year over year, and that's on top of 53% in 2022, 63% in 2021, and 38% in 2020. Don't forget, because of this whole student loans forgiveness thing, they have been obviously working with some headwinds, which hopefully will turn into tailwinds sooner rather than later. But overall, even with all of that, they still either met guidance or exceeded and then raised guidance and met it and exceeded again. So really, execution has been top notch here. Now, again, they do say here, this guide assumes positive quarterly GAAP net income in Q4 2023 and a 20% incremental GAAP net income margin for the full year. And I think that when this will happen, the market will suddenly flip the switch and the stock will react accordingly. And so that was SoFi. Pretty short explanation because I don't want to waste your time and go over the same thing I mentioned in the last video. Again, you can check those out. Those will be in the top right corner. Then stock number 3, and this is a stock that I covered only once before it went IPO. Pretty popular stock with some of my viewers here, and that's Duolingo. Yes, Duolingo is a company that went public not so long ago, and yes, you are probably using this if you're trying to learn a new language. Now, surprisingly, they're doing quite well. Even after or coming out of the pandemic, the company is still growing quite nicely. Now, I do have one issue with that, and that's on a valuation basis, it is not cheap at all. So let's have a look. So revenue in the last 12 months, $369.5 million. Free cash flow positive, $48 million in the last 12 months. Return on equity is still negative here, 11.29%. Gross profit margin, 73%. Then as you can see here, price to sales ratio in the next 12 months, pretty expensive, 11.8 times. Now, of course, if you look at forward PE, which again doesn't really make that much sense, 120 times that. Now, year to date, the stock doubled. It's up 100%. Over last year, it's up 50%. So the stock has definitely outperformed the overall market. Yes, I was also surprised when I saw this. And so these were the numbers for Q4 and for fiscal year 2022. So daily active users grew 62% year over year. Monthly active users grew 43% year over year. Paid subscribers are up 67% year over year. And then paid subscriber penetration as a percentage of monthly active users is now 7.8% compared to 6.2%. So again, momentum here has been going up, and that's great to see. Of course, the fears were that coming out of the pandemic, those numbers were going to trend down. Logical assumption, right? But they proved the market wrong. Now, as for fiscal year here, we can see revenue is up 47% year over year. Total bookings are up 46% year over year. Net loss is still a loss, right? $59.6 million. Adjusted EBITDA, $15.5 million with a 4.2% margin. For Q4, margin was 5%. And yes, you guessed it. So looking ahead to 2023, they say here, in addition to the thousands of A/B tests we normally run to approve our products, we're focused on two emerging opportunities. One, generative AI, and two, English language learners. No surprises there that a company like Duolingo will go on the, let's say, hype train or trend of generative AI, but I do think that they can use this much better than other hyped up companies that just use the name generative AI to gain a bit of traction. I think Duolingo will definitely gain from this, and its users as well, obviously. Now, looking ahead for this year, they mentioned something like this. So, with over 2 billion people learning languages around the world, we have a huge market opportunity ahead of us. We believe we will continue to grow the top line rapidly as we progress towards our long-term adjusted EBITDA margin target of 30 to 35%. This year, we expect to achieve an adjusted EBITDA margin of 10 to 12%, up from about 4% in 2022. This implies more than 30% of incremental flow through the adjusted EBITDA in 2023, with the second half of the year showing even higher incremental profitability. Of course, I think the majority of people invested in this business are looking towards a more profitable business right now, because we do know, we've seen top line growing, no problems there. But let's see how profitable this business can be. And now stock number 4 is also the stock number 4 I mentioned last month, which is up around 15% right now. Not saying I was a genius. I think this was a logical move and logical thing to do. And it's Alphabet. Yes, I know we're all tired of hearing about Alphabet, about Microsoft. But let's face it, when there is a very, very good opportunity to buy a quality company for a long, long time, it's usually the best time to buy when there's a lot of noise out there. I've been saying this for the last couple of weeks. I've said this with Netflix and Facebook, with Tesla as well. When everybody was saying, oh, we're going at $60 or $70. Well, guess what? We're now over $200. Lowest we went was $101, $102. So again, when the noise is the loudest, usually that's a good time to start looking into a company and maybe even opening up a position. And so that's why I have to mention Alphabet yet again, even though the stock is up 15% in the last month. I think the stock, the company, of course, there are still risks, which we're going to talk about right now, but the opportunity ahead, in my opinion, is bigger than the risk. Of course, I might be completely wrong. In a couple of years' time, we're going to have a look at this and see, this was a turning point where this gigantic company, well, went downhill. Of course, do share your comments down below. So the current state of Alphabet hasn't changed that much since the last time we've covered this. So I'm just going to go over the valuation here. So price to earnings growth right now in the next 12 months sits at 1.32 times, forward PE of 20.4x. Not that expensive for a company like Alphabet, in my opinion. So year to date, the company is just up 17%. I'm saying just up because, well, it took a huge hit. Stock is just over $103. Now, a couple of things here. One, don't laugh. Yes, this is a note from Credit Suisse, but they talk about YouTube's engagement. So they say here at this point, the firm does not have reasons to believe that its estimates for online advertising for 2023 should really increase as budget growth expectations seems bracketed to a 0 to 5% range. More near-term checks are pointing to an in-line to slightly better result for search in Q1. The firm also notes that feedback for YouTube remains soft given higher brand exposure. As such, its current 2023 FX neutral growth projection for search and others stands at 3.4% and YouTube at 4%. Credit Suisse also updates engagement time spent data, and the time series continues to suggest that YouTube has effectively triaged the potential challenge for the proliferation of TikTok, and the firm has an outperform rating on the shares with a price target of $136, so they see approximately 30% growth here. Then on a more negative note, we have an analyst at Piper Sandler that has lowered the firm's price target to $117 from $120 and keeps an overweight rating on the shares. Now, the analyst says artificial intelligence is a real risk to Google search revenues. The firm estimates $15 billion of sales will be at risk by 2025, or 7% of Google's total. Google historically has been a leader in AI, but so far appears flat-footed versus Microsoft. However, Piper believes this issue is already reflected in Alphabet's valuation multiple. And yes, I think we can all agree that Alphabet's reaction to, let's call it the AI revolution that happened in the last 6 months or so, has been lackluster. But again, Alphabet, they have been investing billions and billions in AI. I'm sure they have some products that they are yet to release that will probably blow our minds. We've covered a couple on this channel. These videos will be in the top right corner. And I'm going to talk about Microsoft and Alphabet and the monetization of chatbots in the next video probably. And that's a way for Google as well to monetize what they are monetizing right now in search. But if you want to move to a chatbot, how do you monetize that? There is a huge opportunity there. I'm also going to mention Meta as well. And last thing here, when it comes to, well, spending cuts, which I think the majority of the market would agree that Alphabet still needs to do a lot of those. So apparently the CFO of both Google and parent company Alphabet said in a memo to employees to expect more spending cuts as the company tries to meet savings target this year. Just as we did in 2008, we'll be looking at data to identify other areas of spending that aren't as effective as they should be, or that don't scale at our size. This work is particularly vital because of recent growth, the challenging economic environment, and our incredible investment opportunity to drive technology forward, particularly in AI. I think the majority of the market right now is expecting Alphabet to report Q1 earnings in line, if not beat a little bit, but I think a lot of people will be looking to hear whether or not they see some improvements towards the back half of the year. What's up with those cuts in expenses? Are they going to increase it? Yes or no? I think this is going to be extremely crucial there. Again, the same example over and over is Meta. A lot of noise, the company has been hit left, right, and center last year, and rightfully so, because the business was deteriorating. But then they flipped the switch. They started to cut. The market liked it. Of course, this will streamline the bottom line, and growth should be much better from there on top and bottom as well. So those were the 4 stocks for the month of April. Of course, I can mention a lot of other companies. Yes, Axon Enterprise should be maybe on this list, but I'll keep this one maybe for the month of May. Of course, do share your thoughts down in the comments below. If you're picking up some companies, which one are those? Let me know down there. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.